Bitcoin inflows have dropped significantly. Miners are reluctant to sell, ETH withdrawals are happening, and AI agents are directly entering the market to trade. With the industry retreating and profits bottoming out, can the crypto market see a turnaround? Tuesday, March 4th, CoinTV Chinese channel. Where's the blockchain? I'm Lucia. First, let's look at the most important crypto headlines from the past 20 hours. On-chain data is now giving us a pretty crucial signal. Bitcoin inflows into exchanges have noticeably decreased. Currently, the total inflow is about 28,235 bitcoins, which is far below the historical average. Now let's take a look at past patterns. Whenever inflows exceed 90,000 bitcoins, it usually indicates that many people are preparing to sell, and the market is likely to reach a short-term top. On the other hand, when inflows drop below 40,000 bitcoins, it means fewer people are selling, and the market gradually enters an accumulation phase. The most dramatic instance in this cycle occurred on March 5, 2024, when nearly 30,000 bitcoins flowed in. Later, on July 17th, there was also a high inflow of 90,000 bitcoins. Each of these market fluctuations was quite significant. Now let's take a look at the current market situation, which is exactly the opposite. The act of people moving coins to exchanges in preparation to sell has noticeably decreased. On the macro level, the situation in the Middle East has pushed up oil prices. WTI is at $75, Brent at $82, so risk assets are under some pressure. Meanwhile, Bitcoin is still hovering around $68,000. Structurally, selling pressure is decreasing, and the market is slowly approaching a possible accumulation phase. On-chain data has recently revealed another signal. Miners don't seem to be in a hurry to sell their coins anymore. The Bitcoin Miner Position Index, NPI, is now around -0.93, which has dropped to its lowest point in recent weeks. When the NPI turns negative, it usually indicates that miners are transferring fewer coins to exchanges than usual, meaning their willingness to sell is decreasing. However, at the beginning of the month, the situation was quite different. On February 5th, the NPI once surged to 2.95, and the number of coins miners moved to exchanges increased significantly. This kind of scenario often occurs during periods of high market volatility, when miners sell some of their holdings to lock in profits or cover operating costs. As the market gradually stabilized, miners also began to calm down. After February 20th, the NPI continued to decline and entered negative territory. Of course, it's also worth noting that in February, nearly 198,000 bitcoins flowed from miners to Binance, indicating that there was indeed a significant capital shift during that period of volatility. Now that the price has returned to around $68,000, miners seem to be taking a wait-and-see approach, holding onto their coins. Structurally, miner selling pressure is weakening. Let's look at another very obvious move. Many people have already withdrawn their Ethereum from exchanges. Since February, a total of about 31.6 million Ethereum have been withdrawn from major exchanges, the highest level since last November. This indicates that funds are moving from exchanges to private wallets or longer-term holdings. The largest withdrawals are from Binance, with about 14.45 million Ethereum taken out, which is nearly half of the total, while HKEX saw about 3.83 million Ethereum withdrawn. Usually, such large-scale withdrawals mean the coins are being moved to cold wallets and are not intended for immediate trading, so the amount of coins available for sale on exchanges decreases. If this trend continues to expand, when market demand returns, price fluctuations could be amplified. Please like and turn on the notification bell. We monitor news updates for you 24/7. Our channel takes a macro perspective, providing in-depth integration in just 15 minutes to help you quickly grasp major changes in the digital asset space and enhance your understanding. Let's take a look at today's news. Has anyone noticed? Lately, it's harder to trade on-chain. Prices move before you can buy. It's not that you're slow, your opponent has changed. In 2024, AI agents are trading directly. They don't just watch the market, they place orders for you. They scan data and security faster and more precisely than humans. HKEX, BitGet, and Binance have all launched AI skills intensively this week, and the decentralized exchange Uniswap has also started rolling out skills, allowing AI to directly participate in DeFi operations. Your trading counterpart may no longer be human.
Recently, several exchanges have launched AI skills. OKX's on-chain OS platform allows AI to operate wallets using natural language, trading and reading on-chain data across more than 500 dApps. It supports more than 20 mainstream public blockchains. BitGet Wallet's skill can scan token prices, analyze LP depth, and generate the optimal swap route, integrating liquidity from over 110 dApps and covering a multi-chain environment.
When the user asks for something, the model decides to use a skill if needed, then requests the full skill.md for that one skill by emitting a tool call.
At the same time, Binance also announced the launch of the first batch of 7 AI agent skills, allowing AI agents to access Binance-level market data and trading infrastructure. Binance stated that AI-generated content is for reference only, and the data may be delayed or contain errors. Users still need to conduct their own research and properly manage their API keys.
AI entering the market sounds great, but there's something that needs to be said up front. The more powerful the tool, the greater the cost of using it incorrectly. If the algorithm goes wrong, market fluctuations can be even more intense than manual operations. AI can help you move faster, but it can also make you lose money just as quickly. A more realistic issue is that AI might become the new smart money, widening the gap between retail investors and institutions. While we see the positive side, we must always remember the most important point. AI-generated content is only for reference. No one can do your own research diary for you, and you need to keep your API keys secure, otherwise AI might end up leading you into a trap. To sum it up in one sentence, AI makes trading smarter, but the risks in the market have never disappeared. Over the past 2 years, the direction of the Bitcoin market has changed quite noticeably. During the bull market in 2021, the profit from a single mining machine could reach as high as 90%, but now those profits have almost been squeezed out. The price of Bitcoin has dropped 50% from its peak last October, while the overall mining difficulty keeps increasing and electricity costs continue to rise. That's why many publicly listed mining companies have already started to transform their business. Iron cleared out its Bitcoin inventory and shifted to providing high-performance computing power. TeraWulf and Cipher Digital have also reduced their mining operations and shifted toward HPC and AI data centers. So over the past year, the major computing power giants have collectively sold more than 15,000 Bitcoins, investing the proceeds into AI computing infrastructure. Simply put, the industry is already voting with its feet. Mining is becoming less and less profitable. But at this very moment, while everyone else is pulling out, American Bitcoin, backed by the Trump family, is doing the opposite and continuing to increase its investment in mining. American Bitcoin, co-founded by Eric Trump, announced on Tuesday the purchase of 11,298 ASIC mining machines, which is expected to boost its computing power by about 12%, adding 3.05 exahashes per second and accounting for roughly 0.3% of the global hash rate. The mining machines will be deployed in March at the Drumheller mining site in Alberta, Canada.
The beauty of Bitcoin mining is we don't need to speculate as much on the price of Bitcoin itself. As miners, as long as we are more cost-effective and more efficient than the rest of the network, we will always be profitable, regardless of whether Bitcoin rises much higher from current levels or even if Bitcoin drops by 50%, 60%, or 70%.
According to current network data, the newly added computing power can mine about 42 more Bitcoins per month, which annualizes to about 515 Bitcoins. The monthly gross revenue is around 2.9 million US dollars, but this is a gross figure before deducting electricity costs and changes in mining difficulty. Eric Trump stated that the company's goal is to keep the computing power firmly in the hands of Americans. However, on the day the news was announced, American Bitcoin stock price actually fell by 2.6% to 99 cents, indicating that the market was not convinced. Ultimately, expanding computing power is one thing, but whether it can actually make money is another matter. The reason American Bitcoin dares to buy mining machines against the trend is mainly because their electricity costs are lower than their competitors. When high-cost miners can't hold out and shut down, the mining difficulty naturally decreases. But this logic also has its prerequisites. Electricity must be cheap enough, and can the coin price stay above the cost line? The 11,298 mining machines are a sunk hard cost. Having higher computing power only increases the chance of grabbing a share. It is not a guaranteed ticket to profitability. Two things decide if a mining company survives: having cheaper power than rivals and Bitcoin's floor price before you must shut down. Uniswap wins its lawsuit after 4 years, ushering in a new dawn for the DeFi industry. Bitcoin as a store of value, USDT payments, Africa unlocks crypto credit cards. 4 years ago, a group of people who bought scam tokens took Uniswap to court. It sounds perfectly reasonable. If there's a problem on the platform, you hold the platform accountable. But the issue is that a decentralized protocol isn't a company, code isn't an employee, and there's no one behind the scenes actively selling fake tokens to you. So it took the US courts 4 years to figure out this logic. On March 2nd, a federal judge finally issued a long-awaited legal ruling for the DeFi industry. Those who write code are not liable for third parties misusing that code. But users must remember, just because developers have no responsibility does not mean your money is protected by anyone.
On March 2nd, Judge Catherine Polk-Failla of the U.S. District Court for the Southern District of New York dismissed all class action lawsuits against Uniswap Labs and co-founder Hayden Adams, ruling that open-source smart contract developers are not liable for scam tokens issued by third parties. This decision is final. The case began in 2022. The plaintiffs accused the platform of being rife with rug pulls and pump-and-dump schemes, and the defendants also included venture capital firms Paradigm and Andreessen Horowitz.
Brian Neisler, Uniswap's head of policy, celebrated the ruling on X, calling it another precedent-setting ruling for DeFi. He highlighted what he described as his favorite quote from the case. It defies logic that a drafter of a smart contract, a computer code, could be held liable for a third-party user's misuse of the platform.
The judge compared Uniswap to neutral tools like email, stating that holding smart contract developers responsible for third-party misuse of the code is illogical. The federal securities law claims in this case were dismissed in 2023, and this ruling represents the final judgment at the state law level. Uniswap co-founder Hayden Adams stated that legal responsibility lies with the scammers, not the developers. The Uni token followed the broader market trend, rising by about 2.7% in the past 24 hours. The significance of this lawsuit is not just that Uniswap won, but that for the first time, a US court has clearly addressed a core issue. When financial infrastructure becomes code, who is ultimately responsible? In traditional finance, exchanges, brokerages, and custodians all have a complete and well-defined chain of responsibility. But in the DeFi world, protocols are just automatically running programs. There's no customer service and no risk control department. And the signal the court sent this time is actually very clear. Code can be a tool, but a tool is not the same as an institution. For developers, this sets a boundary that protects innovation. But for users, it also means a more direct reality. In decentralized finance, many risks have to be shouldered by oneself. Whether DeFi can truly go mainstream in the future may not depend on technology, but rather on how to find a new balance between code, rules, and investor protection. In fact, the reason Bitcoin has become popular in Africa is due to a very practical logic of self-rescue. When the local currency is unstable and many people don't have bank accounts, stablecoins and Bitcoin naturally become a viable alternative. The former Secretary General of the United Nations once mentioned that in some African countries, the scale of overseas remittances even exceeds that of external aid. But if you use traditional remittance channels, about $6 in fees are taken for every $100 sent. In addition, more than a dozen countries have inflation rates exceeding 20%, and about 650 million people are unbanked. So the role of digital assets is not just as an investment, but has become a kind of financial infrastructure. From this perspective, the significance of Bitcoin in Africa is far more than just being digital gold.
Stafford Macy, executive chairman of a Bitcoin company in Africa, recently stated on a podcast that in his region, Bitcoin is not a tool for saving money, but rather a currency for daily payments. Many merchants do not accept US dollars, but they do accept Satoshis, the smallest unit of Bitcoin.
In terms of movement of money, we can argue that, Bitcoin becomes kind of your savings account and your USDT is your checking account. It's evolving. So that's one part of the narrative that I have seen.
Chainalysis data shows from July 2024 to June 2025, Sub-Saharan Africa's on-chain volume topped $205 billion, up 52%, making it the world's third fastest-growing crypto region. In March 2025 alone, monthly volume neared $25 billion. Nigeria's currency devaluation fueled trading, while a high share of small transactions shows active retail participation.
Cryptocurrency trading in sub-Saharan Africa is now booming at both ends. Ordinary people are making frequent small transfers, while institutions rely on stablecoins for cross-border trade. The rapid growth in data ultimately comes down to the fact that local currencies can depreciate at any moment, so people have no choice but to rely on digital assets to get by. This also shows that crypto assets have truly taken root in Africa, not just as a buzzword, but as a real solution to people's pressing problems, and it points the way forward for other emerging markets.
Trump called out major banks on Truth Social, accusing them of threatening and undermining the stablecoin bill, while also urging Congress to swiftly pass the Clarity Act. JP Morgan CEO Jamie Dimon also weighed in, saying that if stablecoins pay interest, they should be regulated according to banking standards. On the policy battlefield, crypto has won in the courts, but it hasn't yet won over Wall Street. In the past 5 trading days, spot Bitcoin ETFs saw a net inflow of $1,450 million, pushing BTC to rebound to nearly $70,000. Retail investors are selling while institutions are buying. This script plays out the same way every cycle. Moreover, Core Scientific announced it would sell almost all of its Bitcoin and shift to building AI data centers, while Mara also hinted in SEC filings that it plans to offload $3.6 billion worth of BTC reserves on a large scale this year. The coins they mined are being handed over to others by their own hands. Prediction market, Polymarket faced strong public criticism for launching contracts to bet on the detonation of nuclear weapons and promptly deleted all of them. Even the platform itself couldn't withstand the backlash over betting on the end of the world this time. Near co-founder Ilya Polosukin stated that AI agents will replace humans in directly operating wallets and will become the largest user group on the blockchain. In the future, when you buy coins, it might be your AI placing the order for you. It's faster and more rational than you are.
Many people overcomplicate the workplace, but what truly determines how far you go usually comes down to just 2 things. First, reliability. Second, consistency. The people who are truly trusted in a company are often not the smartest, but they are always the most dependable. If you can take on tasks others are unwilling to accept and finish what others give up halfway, then over time, opportunities will naturally come your way. Many people always think they should wait for opportunities before working hard, but in reality, it's the other way around. Only by doing things well first will opportunities appear. There aren't that many overnight success stories in the workplace. Most growth happens quietly. When you solve a problem, take on a bit more responsibility, or learn a new skill, it may seem insignificant at the time, but over the long run, it becomes an advantage. Remember this, the most valuable thing in the workplace isn't intelligence, but being the person others think of first when something important needs to be done. When you become the person people can trust to handle things, it's only a matter of time before you get the position and rewards you deserve. All right, that's the in-depth analysis for this episode. Our channel is always focused on the core narratives and value discovery in the digital asset field. If you agree with our logic, feel free to subscribe to our latest updates and enable real-time notifications. If you want access to higher-level research reports, you can follow our advanced channel. From Monday to Friday, we will share in-depth reviews of market cycles, capturing certain opportunities within trends. See you tomorrow.